Hello everyone and welcome back. In the next few classes, I will be discussing financial statements. I know that some of you might not be very excited about this topic and might not like accounting, but I promise I will try to be to make it as easy as possible. And an overall understanding of accounting is very important, regardless of your main job. Even if you're doing marketing or law, understanding a little bit about accounting is important because accounting and financial statements are the business language. So understanding few key terms will help you along the way. Today we will start with a balance sheet, which is one of the main financial statements. And in the next classes, we'll discuss also the other financial statements and as well how to make a break-even analysis. The general purpose is to help you to understand terminology and also some basic knowledge of financial techniques that again might be useful to start your company and think about business in general. So I already gave you a few hints, but what are the main financial statements? There are 4 financial statements, and probably 3 of them are those that you might come across more regularly. So the first one is the balance sheet, which is also the one we are going to talk about today. And it provides a snapshot of a firm's financial position at one point in time. So we'll tell you what the company owns and owes at that point in time, for example, at the end of 2019. The second financial statement is called income statement, and this will summarize firm's revenues and expenses over a given period of time. So the balance sheet will only give you the period at the last day of 2019 or the last day of 2018 or Q1 2018, whatever you want, one day, which is also the last day. The income statement will give you the full period. So for example, if you have a 1-year income statement, it will give you the revenues and the cost from January 2019, 1st of January to the 31st of December 2019. The statement of changes in equity shows movement in equity. This is usually a bit less important. Usually companies don't discuss this very deeply. The last one, which is very prominent, is called statement of cash flows. And this reports the impact of a firm's activities on the cash flow over a given period of time. So similar to the income statement, you can have a cash flow statement from 1st of January to 31st of December. Income statement and statement of cash flows might be similar, but accounting principles make them different. Having more income doesn't necessarily mean that you have more or less cash flows. There might be some, again, accounting differences that make them a little bit different. So different names, same meaning. So in different countries, different companies might use slightly different names for the same statements. And also there are different accounting rules. For example, Europe and the United States do not have the same exact accounting rules. But more or less, when you have an income statement, it would be very similar across countries and also will be similar across different names. So usually the way I call them is balance sheet, income statement, and cash flow statement. But other people, other companies might use different terminology, different names. So they did this slide that tries to explain that different statements are interconnected. So for example, here you can see on the left, the balance sheet at the beginning of the year, you will have certain assets, liabilities, and equity. And on the right side, you will have assets, liabilities, and equity at the end of the year. In between, you might have changes in equity that are related to, for example, net profit. And of course, the equity that you have at the beginning of the year will be in between and will impact the equity that you have at the end of the year. And of course, the income statement where you have revenues, you have expenses, will have net profit, which in turn will also affect your cash flow. So in today's class, we are not going to discuss in details how these are interconnected, but it is important that you know that the 4 statements will need to make sense across each other, okay? Again, assets will be into cash, and then cash will be into assets. The same goes for equity. All these documents are interconnected, and if the numbers don't match, there is a mistake there. So in my classes overall, I try to focus on the statement of cash flows, because as we mentioned in the first classes, cash is more important for young tech innovative startups. But we will also give you a brief outline on each of the other of the three, and in particular today it will be the balance sheet. So let's start with a simple example on how assets and cash will change in a simple pizza delivery business. I know this is probably not a tech example, but I would encourage you to pause the video and think about this before you move forward. So what are the key financial factors, numbers in a pizza delivery business? So not only the cost, start to think if you have to project the future, if you need to think how your business will develop, will grow in 1 or 2 years, what are the key numbers that you need to think of? For example, you might think how many kilometers my driver will need to drive from the pizza restaurant to the delivery person, to the customer, the cost of fuel, the price of delivery. So what are the numbers that are important? What are where your revenues are coming from, where your costs are going to be spent, what type of assets will you need to buy? Maybe you need to buy a scooter. So just think about this. This will help you ready to design these potential financial statements and to make cash flow projection as well as a balance sheet projection that you will have in the future. So pause the video and think about this. Again, these are just examples. You can think about how much you want to charge per delivery, how many deliveries you can expect per month, what will be the salary of your driver, and so on. You might need to start with some initial investments, which will be your assets, for example, a scooter, which will have a cost. All these will be numbers that will help you to design a cash flow projection, think about the type of capital, the amount of capital you need, and how these will impact your future business. In the next slides, we will try to see how these different types of costs will be need to place in the different accounting statements, but also they will all be in your cash flow projection, especially if you're looking at management accounting, which, as we have mentioned in the previous classes, can be very flexible and does not need to follow the government regulation on the accounting principle on financial statements. So talking about balance sheet, which is today's main topic, what's inside a balance sheet? So you might remember my example in the first class about buying a house. So net worth is also called equity. And so in this case, we are looking at the Coca-Cola example. You can see that Coca-Cola across the years of 2011, 2017 has reduced their equity. So this is also the accounting book value of the company. Here we are probably looking at 30 billion and maybe here $20 billion. In the blue color, you have long-term assets and long-term liabilities. In the purple, you have short-term liabilities and short-term assets. In the next slide, we will explain what it is. But remember, when you have the house, you have your asset, which is your house, then you have your mortgage, which is your liability, and the difference is your equity. In this case, you can see that Coca-Cola overall has approximately $90 billion in assets, $70 billion in liabilities. Also, you can think about mortgage. So the ownership, the equity of Coca-Cola is 20 billion, which is a difference between 90 and 70. Okay, so let's go into more details into what's inside, again, the balance sheet. So in the previous slide, you can see that there's long and short-term assets and liabilities. You can also think about current liabilities as short-term liabilities, non-current liabilities as long-term liabilities. So on one end, you will have current assets, non-current assets. On the other end, you have current liabilities and long-term liabilities or non-current liabilities, and the difference would be the equity. Again, think about the example of the house. You have assets, liabilities, and equity, okay? So when we're talking about current assets, We are talking about all assets that can be converted into cash within the next 12 months. Okay, so this includes, for example, cash, bank deposits, or inventory, or even short-term credits, so account receivables from our debtors. For example, if you are a supermarket and you have a lot of Coca-Cola cans, you can sell them in the next month and then your customers will give you cash. So that inventory is a short-term or current assets. Cash is the best assets you can have because it's by definition very short-term. You can use it any day. So current assets are assets that can be converted in cash within a short time frame, which is 12 months. The opposite is true for non-current assets, which again can also be called long-term assets. These type of assets are long-lived assets that you will need to spend more than 12 months to convert into cash. So these are more medium to long-term assets. For example, your house is probably a long-term or non-current assets. Other examples can be land, buildings, warehouses, motor vehicles, equipment. So anything more substantial, more long-term, that again takes longer than 1 year to be consumed. Okay, so we have two types of assets, short-term or current, and then we have non-current or long-term. The difference is the amount of time required to convert them into cash or consume them. We can also have non-current assets that are non-tangible. We have discussed in the previous class the difference between a building and a brand is that a building is tangible while brand or trademarks are non-tangible. You cannot touch them. And so in this case, they can be acquired on most of the time, and so they will be in your balance sheet. On most of the time, intangible assets, they are not in your balance sheet. Okay, so it's a type of asset which is very valuable, but that most of the time will not be in your balance sheet, nor in the companies that are listed in the stock market, unless they are acquiring a brand from someone else. So finally, we also have equity and liabilities. So we have assets on one hand, and the total number of assets, the total value of the assets needs to match equity plus liabilities. Remember, you have a house worth 1 million, you have a mortgage worth 800,000, your equity will be 200,000. And this is the same that you can see in this slide. Liabilities is basically any debt or mortgage or loan that you owe to someone else. And equity is your claim of ownership, which is again the difference between what you have and what you owe to someone else. The difference is yours. Similarly to assets, we can have current liabilities and non-current liabilities. Current liabilities, they are short-term liabilities. For example, your bank overdraft. You need to pay that within a month or 2 or 3, so shorter than 12 months. You might need to pay your suppliers within 3 months. So this type of debt and bank overdraft will be called the current liability. So debt that you need to pay in a short time frame. The opposite is non-current liabilities. So these are liabilities or loans that you need to pay in a period longer than 12 months. For example, a 30 years mortgage would be a non-current liability or a long-term liability. This is a question for you. Think about it before I move on to the next slide. Is it better to finance your operation with long or short-term liabilities? In general, the answer is that you would like to match your duration of your assets and the duration of your liabilities. For example, you don't want to pay for the purchase of your house with a credit card, because of course you will need to pay your credit card debt every month, while your house is probably a long-term asset. And so you want to buy your house with a long-term mortgage, for example, 20 or 30 years. Because if you need the money and you need to sell your house to pay back your credit card, you will probably struggle to sell your house within 1 month. The same goes for companies. So if they're buying a warehouse, they might want a long-term mortgage. If they're buying a car or a truck, they might want a medium-term loan. If they are financing, for example, their inventory, and they think they can sell the inventory within 3 or 6 months, a short-term loan of 3 to 6 months might be a good option. Because usually, remember, time value means that if you have a long-term loan, it will cost you more than a short-term loan. So you don't want to be too careful or not careful enough. Matching the duration is usually the best way to go. An important caveat is that accounting book value, it's usually backward looking, is looking at the history. So these might differ from the market value. And in case, for example, we discussed in previous slides companies such as Tesla, you might remember that Tesla had a market value, I think was $70, $80 billion, but their book value was only $8 billion. And this is because a lot of intangible assets of Tesla, such as their human capital, their brand, their technology, these are not in the accounting value of the firm, but the market is willing to pay for it. So imagine if you have a house and someone very famous has lived inside the house. So the book value of the house will be the amount of money you're paid for it. But by having someone famous, the market value will increase because some people might be willing to pay more money to live in that house. The same is for companies. There is value outside of your accounting value. Let's give you an example of a balance sheet of Coca-Cola. So this is the exact real balance sheet of Coca-Cola. So you will see here in millions of dollars, this is end of 2016, you will see that here you have all the assets of Coca-Cola, and here you have the liabilities and the equity of Coca-Cola. At the bottom, you have the total, which was $87 billion in assets, and you can see the total of $87 billion in liabilities and equity. In total, you have $23 billion of equity. So this is the amount of capital that the owners have in the company. And this $23 billion is the difference between the total assets and the total liabilities. So if you do 87 minus 64, you have $23 billion in equity. You can also see here that they have total current assets, so short-term assets. For example, inventory, $2.6 billion, cash, $22 billion, and so on. So total short-term assets, $34 billion, but they also have long-term assets, such as, for example, property, plant, and equipment, worth $21 billion. The same is on the other side. Here you can see that they have total current liabilities, so short-term loans of $26 billion, and total long-term loan of $29 billion, okay? And so the total between 29 and 26 is basically 64, adding these other smaller items. So again, on this side you have assets, on this side you have liabilities and equity, and they are both divided in short-term and long-term. The question is why the market capitalization of Coca-Cola is 189 billion, but the owners only have 23 billion inside. And the answer is, again, what we discussed before for Tesla, is that the brand of Coca-Cola, which is one of the most valuable in the world, is not inside the balance sheet. You can see in the 2017 rankings of Interbrand, that was worth $70 billion. And so this already bridges a gap between the market value of Coca-Cola and their accounting or book value that you can see in the balance sheet. Of course, there's also what we mentioned before, for example, future cash flow projections. These will add to the value of Coca-Cola.